All right, okay, ladies and gentlemen, hello everybody. Hi, my name is Darius Anucauskas and I'm the global market analyst here at Markets.com. So look, it's Thursday. I'm recording this one on Thursday on the 6th of March, yes, 2025. Look, the reason for this recording is that we have an event coming up. Well, of course, not for today. Today, I already did the recording, the video recording, the video analysis. Today we have the ECB, but tomorrow we have the long-awaited NFP numbers. Look, and in general, everything with job related to the U.S. market. Look, before we jump into all that, before we do all this, let's quickly have a read through our risk disclaimer. So yes, the content we produce does not constitute investment advice or investment recommendation and should not be considered as such. This material should not be taken as an invitation to acquire any financial instrument or product. I'll give you a few seconds to read the rest. I'm not going to disappear anywhere. So yes, like I said, today we have the U.S. job. Sorry, not today. Tomorrow we're having the U.S. job numbers, which are coming out. So check out the economic calendar when it's coming out in your time zone. Also, before we jump into the charts in general, into data, let's have a quick mentioning of our Markets.com website, which you can always check out for more information about us. So yes, feel free to reach out to us if you have any questions. Look, ladies and gentlemen, let's. The first one I'm picking up here is NASDAQ 100. So lately, as you are aware, the markets are not really feeling the love from the buyers, and well, I mean, we're seeing these nice slides. But the main focus tomorrow will be, let me just open up the economic calendar. The main focus tomorrow will be the U.S. job numbers. Let's jump into Friday straight away. And scrolling all the way to that U.S. data, because look, tomorrow we're also going to have the Canadian numbers as well, so Canadian job numbers. So kind of keep that in mind. Actually, you know what? Let's clear up this a little bit. Let's put Canada and the U.S. together here, Look, for now, if we jump only into the US data, let's pick up on this actually. You know what, let's filter it out a little bit. So if we pick up on the US data, so look, what we're looking at here, we're looking at non-farm payrolls, and the expectation at the moment is for a higher number. Now, of course, people are, or market participants are kind of a little bit in doubt, and I said it myself before Wednesday, before the release of the ADP number. I really don't know if this is going to come out at above 160. Okay, let's maybe it will be a surprise. Look, last time we had the forecast was at 170, then it came out at 143, right? Okay, last time we had a forecast of 160, we came out at 256. So in a way, maybe somebody's thinking, hey, if somebody's following some sort of like symbolism or something like that, number symbolism, then maybe somebody's thinking, hey, you know what, maybe this is going to happen again. We have the same forecast again, right? 160, but is this going to happen for sure? Look, we're getting we're getting the number which is for February, if I'm not mistaken. Yes, so we're getting the February figure, and okay, look. At the moment, we have been seeing some sort of problems in the market in general. We have tariffs all over the place, and we had already throughout the whole February, we had these talks of tariffs, and they started kicking in the beginning of March. But in a way, the fear was kind of already was there and in February, and maybe this is where people or companies start maybe potentially postponed creation of new jobs. because again they want to see how this is going to go, and they want to employ too many people, just because they're not sure how it's going to go further, and maybe that could kind of play out a little bit. Of course, there's another end to this stick, because in a way somebody might say, but hey, you know what if, let's say, on the contrary, companies would try to maximize everything, put maximum output into the into the world, into the economy, and this way try to kind of make as much money as possible before, let's say, those tariffs kick in, so that they would have a little bit of something left to cover themselves. Well, I mean, in this way, basically employing and creating more jobs. Well, again, that's another, like I said, theory on this one. So I would say, if you're not sure which one to stick to, which theory you prefer, or you feel more strongly about, then I would say just wait for the number to come out. That's the easiest way. So in general, I always say to people, like I say to all the traders like out there, that look, don't rush. Everything's fine. I mean, let's say, don't try to pretend that you can foresee the future or something like that. No, just analyze it. You can look at different things. You can look at different how to say, scenarios, but when it comes to the actual number, just wait for it. Wait for it to come out, and then you can do something about it. So look, my problem here right now is also with the unemployment rate, which is kind of flat at 4. So it has been dropping, or has been a little bit higher. Now it's kind of flat at 4, and the expectation is that it's going to come out 4. But if it somehow pops back into 4.1, this is where it's creating a little bit of a few problems in the market, in my opinion. At the moment, looking at this picture, you're seeing that we're seeing this sell-off that happened after hitting the all-time highs here on the S&P 500 and Nasdaq, and we're now resting near that 200-day EMA, which is shown as the white line. So, but apart from the S&P and the Nasdaq, which are resting, or which already tested their 200-day EMAs, it seems like Dow. I'm looking at the cash index right now here. Dow seems to be kind of not there yet. Let's put it this way. It's not there yet. It seems it still wants to test that line, and I'm strongly encouraging it, because in general, what I see, in the movement of these indices, and all these 3 indices. By the way, you know what? Let me just shift this, and let me just do this on one image. There we go, and this one is going to be Nasdaq. There we go. So that's correct. So these are all daily charts. And we can see that we're all kind of on the weaker side, and the S&P and the Nasdaq have already tested their 200-day EMAs. Dow is a little bit on the lagging side. So in a way, look, I'm kind of basically, what I'm trying to say is that I'm leaning a little bit towards maybe worse numbers, because if to follow the logic that that Dow needs to also test the 200-day EMA, it's not a rule. Don't get me wrong, it's not a rule. It's just something from the past observation in a way. Then we need some negative numbers. Then we need some bad numbers in order to kind of help Dow drop lower a little bit. And then let's not forget, Dow is currently sitting in this little range here, or if we can call it little, this wide range actually, and it's kind of en route towards maybe testing the lower side of it as well. Whereas if we would have something like this, if we would have something like this on the S&P or Nasdaq, then we have already kind of reached all these lower sides of the range, and let me just say, let me just put, so for this one, it's kind of, let's say, somewhere around here. I think for the S&P 500, I think that's kind of the lower side of the range, which we've kind of violated. On the Nasdaq, and I think again it's somewhere maybe around here as well. Again, somebody will debate this. They'll say, hey, some maybe here. That's absolutely fine as well. This is also a good one. And in general, somebody might say, hey, what about Darius? What about the double top patterns? Look, That is the case, of course, as well. It could be the case, but again, that's why this 200-day EMA for me is kind of, working out perfectly, because that's kind of the, let's say, it's around the neckline as well. So, you can look at it from the perspective of a double top, but if you're looking at NASDAQ here, for example, then you might say, hey, but we already broke the double, the neckline if it's here somewhere, right? Let me just, if this was the neckline somewhere around this area, then we already broke it, so that's why it's already on the bear side. With S&P, we're still kind of flirting with the neckline. With the Dow, we're not really near it, so that's what I'm saying. So if we are looking at these, like, these potential ideas of a double top, then some negative data is required. So that's why I'm kind of leaning, towards the idea that, this whole tariff thing and everything is kind of, working perfectly in a way for now for the bears. That said, I would not rush into things, because when it becomes, something like this, when somebody might say, well, it looks a little bit too obvious, right? Then I wouldn't rush into things. That's why I keep on saying wait for the number to come out. So at the moment, if this comes out, let's say on let's say 4.1, the unemployment rate comes out 4.1, the non-farm payrolls come out, let's say they come out close to previous 143. If they do come out like previous, let's say 143 or 145, or somewhere around that, in that number, somewhere around this, then keep your eyes on the revised figure, because I'm assuming that this is going to be revised. So keep your eyes on the economic calendar for that, because again, this revision here, this is where it's going to play out. Maybe the revised figure will actually be even lower. If that's the case, honestly, we could see some bad activity here, or depends on which side you are, right? I mean, it may be good activity, you would say. So it depends on which side. So maybe good activity for the bears, and yep, we could see further declines. Maybe actually these two indices, the S&P and the Nasdaq, could eventually break below their 200-day EMAs. We're waiting for that to happen on the Dow. I don't know if it's going to happen or not. I don't have the crystal ball. However, like I said, it could be quite interesting. So very quickly, I wanted to touch on another instrument here. Actually, a few pairs here. USD JPY. You can see that this one is also looking at the bear side right now. There's a little bit of fear kicking in here, and the US dollar against the Canadian dollar. Just wanted to pick up on that one, because like I said, we do also have the Canadian numbers coming up. So you need to kind of keep that in mind, because in their situation, we have, where's that unemployment rate, 6.7. So that has been, this is forecasted to come out on the higher side. If it comes out even higher than this, then this is where the interesting bit comes in, because which one's going to outpull which. At the moment, we're seeing some strength in the Canadian dollar, but it's actually maybe not really the strength of the Canadian dollar, it's more of the weakness of the US dollar that's helping this pair to drive lower. But what I said before, I'm going to approach this from the very technical perspective. Look, for today specifically, I'm looking at the 50-day EMA, which is not far from my 1.43 territory. So basically, I'm looking at this 1.43 zone. I like it. If we somehow clear that one, then yeah, I'm going to lean a little bit more towards the downside. For the upside, for me, I need to see a push somewhere above this 1.4466 territory at least. And then yes, we could start considering slightly higher levels. But again, let's be careful. Let's watch the news. Let's watch what numbers are going to come out, because again, if we do see some bad numbers coming out from the US, I mean, look at this, dollar index was already declining. But hey, maybe there going to be some positivity a little bit, because if the numbers come out, and let's not forget one thing actually before I run out of time here, if numbers come out on the lower side, on the bad side, then we need to keep an eye on this organization, the Fed, because at the moment we have the expectation that we will see a 31.6% for 3 hikes at the end of this year. So we're expecting to see 3 hikes by the end of this year, and this is where it's becoming interesting. You know, if the numbers do, like I said, come out on the lower side from the US, then this percentage here could actually rise a little bit more. I'm not saying this is going to shift to 4 cuts. No, I think that just the 3 cut probability could increase. And this is where, you know, the dollar index could continue sliding. So yeah, ladies and gentlemen, thank you very much. I'm going to wrap it up here. I hope this made some sort of sense. Look, I just wanted to share my quick opinion, my quick idea. So let me know in the comments if you do agree or not. And as always, do please subscribe, you know, share and like and all that stuff, you know, that all this YouTube thing. So yes, thank you very much, ladies and gentlemen. Stay safe. Have your stop losses in place. Risk only what you can afford to lose. Don't overtrade, and everything will be fine. I'll see you later. Bye-bye.